Long-term investment success, what's it all about? Market timing, picking the right stocks, getting hot tips from a broker? Well, maybe if you do it consistently, but chances are you won't. What it really takes is investment discipline, sticking to the course, and things like that. Here to talk to us about that is Roger Shore. Roger is a financial advisor with Park Avenue Securities, a registered investment advisor and broker-dealer in Towson, Maryland.
That's right.
Hey, you're talking about the golden rules of investing, and one of those being you've got to have a plan, otherwise you're not going to get anywhere. Talk about that a little bit there.
Well, you know, it was Yogi Berra who said, if you don't know where you're going, you're not going to get there. And I think that the fault with most investors that don't have a written plan is they tend to default to just wanting more return.
Yeah, sure.
More money.
You know, yeah.
And I think that's a little bit like chasing your tail. And of course it's a good thing to want more return and more money, but I think there's a better way.
What do you got to have? I mean, what does a plan have to have in it to make sense? I mean, I want to make as much money each year as possible, or things like I want to pay for college, I want to retire with a certain amount of income. What kind of things should you have in a plan?
That's the general idea. You want to be able to quantify exactly what you're trying to achieve. In other words, it's not enough to say I want to have a happy retirement. How do you plan for that? It's much better to say, you know, there's a certain amount of dollars that I want that I think I'm going to be comfortable with, adjusted for inflation. It's going to be 20 years from now. What do I have to do? What are the things I need to do to get there?
Right. So you as an advisor, come up with the plan. You say, hey, Joe and Mary, you need to put away $800 a month for the next, 40 years to get there. I mean, is that sort of how the thinking goes?
Well, that's part of it.
Get back into it?
Yeah, and then we really want to get back into the three golden rules. I mean, first is the plan, obviously, but now we're talking into an asset allocation. Once we figured out exactly what the investor is looking to do, and by the way, we also have to make sure that those goals are realistic.
Sure, yeah, right.
Because otherwise it's just a waste of time. And if they're unrealistic, then we talk to clients and try to help them get more in touch with their resources.
Yeah, like cat food's not that bad, really. And Roger, you mentioned asset allocation, which is the mix of stocks, bonds, and cash in your portfolio. And generally, I guess the cash and the bonds get higher in percentage as you get older. Is that about right?
That's a fair generalization, but there's a little bit more to it than that. We also have to be mindful of the goal and the client's risk tolerance. In other words, just because somebody's 55 or 60 doesn't necessarily mean they're going to need more bonds in their portfolio than someone that's 50. It just depends how close to their goals they are, what kind of resources they have, what kind of risk tolerance they have, and what the goals are.
Because if you make it to 65, I think you have a good chance of making it past 85 now, too. And if you're married, I think one of you will make it to 90. Yeah. Good chance. Well, listen, we're going to talk about discipline in the investing process, too, in just a moment when we come back with Roger Shore. So stick around on the Forbes.com video network. Welcome back. We're talking about financial and retirement planning with Roger Shore. Roger, as we left, we were talking about asset allocation, and before that, we were talking about, going at your investment with a plan in mind. Now let's talk about discipline. Once you got the plan and you got the allocation right, you got to stick to it. And you've seen people who have messed up.
Yeah. Investor behavior is the third golden rule. That is proper investor behavior. After all, investors are human beings, and many people spend most of their years building those retirement nest eggs. So it's no wonder that when we go into a bear market that they get scared, sometimes panic, and sell out their positions. Conversely, it's no wonder that when we go into a bull market, they get a little bit euphoric, catch a little bit of gold fever, start pouring money into speculative investments. These are the types of improper investor behavior that can really harm an investor's well-being. And I think this is where a professional advisor can add a lot of value, just by continuing to remind their clients, that markets are cyclical. It's the normal order of things.
Well, yeah, bear markets might be the natural order of things, but they can be devastating to a portfolio.
Of course they can, and I've never seen a bear market that didn't end, and I never saw a bull market that didn't end. But I think it all comes back to suitable behavior, proper asset allocation. Because once again, knowing that markets, the normal order of markets is that they do cycle. If people have the right asset allocation in the first place, and they look at their investments correctly, and they have their goals in mind, then there's really no reason for them to sell. And I think proper investor behavior is confidence and patience. So if you follow these three golden rules of investing, I think you'll find that investing doesn't have to be complicated or stressful. I think if you follow them, you'll find that you can be a lot happier with your financial situation.
So basically, don't freak out every time the market gyrates, either on the upside or the downside.
It's perfectly normal for it to do so. It's always been that way. It probably always will be that way.
Keep investing over time. Compounding is your friend.
But make sure your asset allocation is suitable for you, because after all, there's folks out there that just can't tolerate seeing their portfolio go down 25 or 30%, and they get scared out of it. So we have to avoid that, and that's where the proper asset allocation comes in. That's
there's an ineluctable tie between risk and return, though. And if you don't take enough risk, you're not going to get enough return to get you where you want to be, though, in that plan, right? I mean,
and that's where we begin. That's where we begin with the plan. First of all, we have to make sure that the investor has suitable risk tolerance and resources to make those goals that they've set out, making sure they're realistic. If they're not realistic, we have to work with the client and get them to get in touch with reality.
Gotcha. Roger, thanks for coming down here. Roger Shore, he is a financial advisor with Park Avenue Securities in Towson, Maryland. For more personal finance stories, check out the Forbes.com personal finance section at www.forbes.com/finance. Thanks for watching the Forbes.com Video Network.